If you've been watching the markets this week, you've likely felt the whiplash. In the span of a few days, military standoffs, Wall Street power plays, and massive protocol implosions collided at exactly the same time. The week opened with a sudden relief rally. On April 8th, President Trump announced a 2-week ceasefire with Iran, and the markets immediately responded with a surge of buying. But that euphoria hit a ceiling quickly. This line chart contrasts a relatively flat core CPI against a sharply surging headline CPI. That widening gap is the direct result of oil prices reacting to Middle East tensions, combined with those 15% U.S. import tariffs introduced earlier this year. Because of that sticky, conflict-driven inflation, the Federal Reserve is now pinned in a holding pattern. Market expectations for rate cuts have been pushed back well beyond the middle of 2026. The days of cryptocurrency operating in an isolated bubble are over.
The asset class is now tightly tethered to the exact same geopolitical risks and macroeconomic policies dictating global fiat markets. While the macro waters remain choppy, we did get major structural clarity on the regulatory front last month. On March 17th, the SEC and CFTC issued a landmark joint interpretive release. Under this new framework, Bitcoin, Ethereum, and 13 other major network tokens are officially classified as digital commodities, subject to CFTC oversight rather than SEC securities laws. By formalizing this two-lane regulatory system, agencies removed the single biggest legal threat hanging over the industry for the past 10 years, giving institutional capital a clear green light to enter the space. The major assets are absorbing this new reality in very different ways. Bitcoin caught the tailwind of the ceasefire and that softer core CPI data, testing highs around $72,400. But the momentum is fractured. On the left, whale wallets holding 10,000 or more Bitcoin are accumulating heavily. Yet on the right, the volatile Coinbase Premium Index shows that broader U.S. institutional buyers are hesitating to chase the rally. Over in the Ethereum ecosystem, the weekly price chart is forming a bearish structure with a death cross, but looking strictly at price action misses the actual story playing out underneath. The Ethereum Foundation just completed a strategic overhaul of its treasury. Instead of selling holdings for cash, they deposited their final 70,000 ETH tranche into staking contracts to run the network and earn native yield. At the same time, major financial institutions are actively moving portions of the $12.5 trillion traditional repo market directly onto Ethereum's base layer. So, while Bitcoin remains the preferred vehicle for macro traders reacting to inflation data, Ethereum's new commodity status is letting it quietly rewrite the actual plumbing of global finance. If you want to see exactly how Wall Street plans to profit from that plumbing without holding the tokens themselves, you have to look at Bitmine Immersion Technologies. On April 9th, BMNR officially uplisted to the New York Stock Exchange, bringing strict listing requirements and broader investor access. Alongside the bell ring, they expanded their share repurchase program to a massive $4 billion. They are backing that buyback with extreme accumulation. As this pie chart illustrates, BMNR already holds 4.8 million ETH, and they are actively acquiring tokens to hit a stated goal of controlling 5% of the entire global circulating supply. For traditional equity investors, BMNR acts as a highly regulated, leveraged proxy. It offers direct exposure to Ethereum staking yields, completely contained within a familiar NYSE ticker. It is easy to look at NYSE uplistings and CFTC memos and think the entire industry has been sanitized. But the decentralized fringes still carry devastating risks. In early April, the decentralized AI network BitNSOR, or TAO, surged after its community achieved a major milestone, successfully training a 72 billion parameter AI model entirely on a distributed network. But that success was immediately overshadowed when Covenant AI, a leading developer on the network, publicly abandoned the project. They cited deep centralization issues, claiming a small group of insiders actually controlled the protocol's governance. TAO peaked near $332 before violently collapsing to $254, wiping out $900 million in market cap. Notice this massive red volume spike exactly at the crash point. Community members allege Covenant AI executed a $10 million rug pull, dumped him 37,000 TAO before exiting. The contrast is sharp. The top layer of crypto is locking down federal regulations, but if you venture into native decentralized protocols,
you are exposed to brutal, unregulated governance and developer risk. Navigating this market requires a wide lens. You have to monitor Middle East conflict zones, Wall Street equity listings, and decentralized developer feuds all at the same time. To see how the regulatory side shakes out, keep an eye on the Clarity Act Senate markup in mid-April. That legislation will attempt to codify the SEC and CFTC's digital commodity framework into actual law. And for the big picture, the FOMC rate decision on April 28th and 29th remains the primary bottleneck for institutional capital flowing back into risk assets. The rules of cryptocurrency have officially evolved from speculative buying into complex macro strategy. Stay tuned to the brief, and we'll help you navigate the shift.